Ever wonder why rental property owners sometimes look like they've seen a ghost on closing day? It's not buyer's remorse or cold feet. It's a little tax surprise called depreciation recapture, and it's lurking in the shadows of every single family rental sale. Imagine you're a proud landlord who's been collecting rent checks for years, enjoying those sweet tax deductions. You've been writing off depreciation like clockwork, watching your taxable income shrink year after year. Life is good, right? But here's the twist nobody mentions at those real estate seminars. Every dollar you deducted comes back to haunt you when you sell. The IRS doesn't forget, and they definitely don't forgive. So what exactly is this financial boomerang? When you own a rental property, the tax code lets you depreciate the building over 27 and a half years. That's free money at tax time, reducing your annual burden like magic. But the moment you sell that property, Uncle Sam wants his cut of all those deductions you claimed. They call it recapture, and it's taxed at a special rate of up to 25%. Surprise! Now you're standing at the closing table, calculator in hand, watching a chunk of your profit evaporate into recaptured depreciation. Wasn't this supposed to be your big payday? Turns out, the taxman had other plans. Here's where it gets interesting though. Smart investors know the loopholes, and they're not just sitting around accepting this fate. They've got strategies, workarounds, and perfectly legal ways to dodge this bullet. First up, the golden standard of real estate tax avoidance, the 1031 exchange. You've probably heard of it, but do you really understand how it works? It's basically a magic trick where you swap one property for another without triggering any taxes. The IRS says if you're reinvesting your proceeds into another rental property, they'll let you defer that depreciation recapture indefinitely. No sale technically happens in their eyes, so no recapture gets triggered. Genius, right? But there's a catch, because there's always a catch. You've got 45 days to identify a replacement property and 180 days to close. Miss those deadlines by even a day, and the whole deal collapses like a house of cards. You also can't touch the money between sales. It goes straight to a qualified intermediary who holds it in escrow. One peek at those funds, and you've blown the whole tax deferral. Some investors get creative and do a reverse 1031, where they buy the new property first, then sell the old one. It's like doing a magic trick backwards, and yes, it actually works. Then there's the opportunity zone strategy, which sounds like something out of a government brochure because it basically is invest your gains into designated economically distressed areas, and you can defer or even eliminate some taxes. The government wants to revitalize neighborhoods, and they're willing to give you a tax break to help. Here's a wild one. Just never sell. Hold that property until you die, and your heirs get what's called a stepped up basis. All that depreciation recapture, gone, vanished, erased from existence. Your kids inherit the property at current market value with zero tax consequences from your decades of deductions. Morbid? Maybe. Effective? Absolutely. It's the ultimate long game in real estate tax planning. You could also convert the rental back to your primary residence before selling. Live there for 2 of the last 5 years, and you might qualify for the primary residence exclusion. Up to $250,000 in gains disappear tax-free if you're single, $500,000 if you're married. But here's the rub. Depreciation recapture still applies to the rental period. You only dodge the capital gains part of the equation. The IRS isn't completely asleep at the wheel. Some landlords use installment sales to spread the tax hit over multiple years. Instead of one massive recapture bill, you're paying smaller chunks annually. It's like choosing between ripping off a bandage fast or slowly peeling it back. The tax doesn't disappear, but at least you're not scrambling to write a 6-figure check all at once. Cash flow management at its finest. There's also the cost segregation study angle, where you accelerate depreciation early, then use other strategies to offset the eventual recapture. It's advanced level stuff that requires professional help, but wealthy investors swear by it. Partnerships and limited liability companies offer their own quirks too. Sometimes the entity structure itself provides opportunities to defer or minimize recapture through distributions and basis adjustments. Your accountant's eyes light up at this stuff. But let's be real. Most single-family rental owners have no idea any of this exists. They bought a house, rented it out, claimed depreciation because their tax preparer told them to, and now they're selling without a clue about what's coming. That's the dirty secret of rental property ownership. The benefits are advertised everywhere, but the eventual reckoning that's buried in the fine print nobody reads. The real estate gurus on social media won't mention depreciation recapture until you're already committed. By then, you're thinking about exit strategies instead of entry points. And here's the kicker. Even if you never claimed depreciation, the IRS treats you as if you did. They call it allowed or allowable depreciation. You're getting hit with recapture either way, so you might as well have taken the deduction. So what's a rental property owner to do? Educate yourself before that for sale sign goes up. Talk to a tax professional who specializes in real estate. Map out your exit strategy before you even buy the property. Because depreciation recapture isn't some obscure tax technicality that might affect you someday. It's a guaranteed cost of doing business as a landlord, and it's coming for your profits, whether you're ready or not. The only question is whether you'll see it coming or let it blindside you at closing.